Yeah, welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with one of our experts, Amy Meissner. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I will pass the ball back to you, Amy.
Okay.
And I know you've been here before and lots of people know you, but take it away. Well, I think I gave it to Bob, sorry. No, that would help.
All right, there we go. Well, hello everyone. It's great to be here. I haven't done a roundtable in a little while. You guys have been keeping me busy with the alert services that I've been doing here. But it's great to be here, and I certainly appreciate everybody who could attend live. It's always nice because I always like to get. It's always good to get some question and answer thing going. Even though this will be recorded, of course, for later viewing. But I know there's been a lot of activity in the markets recently with the Fed first and then the Brexit, which was quite a surprise for a lot of people. So there's been quite a bit of turmoil. And so I know we originally had planned this presentation earlier today, but because of all that, and I'm sure people need to deal with their positions as well as myself, we decided to do it after market close. So it looks like that probably was a good idea. More people can attend live that way. So hopefully that didn't mess up your schedule and just made it easier for you. With that, I just wanted to get, I know a lot of you guys know who I am, but for those who don't know me, my name is Amy Meissner, and I've been trading options full-time for over 10 years now. My main focus is on income strategies and consistent monthly income. As you may or may not know, I also have a couple of trade alert services on Capital Discussions. Of which I do my two main bread and butter strategies that I've been teaching on here. So that's what I'm going to talk about today. It's been about almost a year and a half, I think. It's been not quite a year and a half, but getting close since I started the Weirdor trade alert service. And it's now going on about 4 months for my nested and Condor service. So Tom and I thought it would be a good idea to go over how everything's going with those trades, and also to talk about a little bit of the differences and compare the two strategies. And of course, if you guys have any questions, during the presentation, obviously put them in the chat box and I'll get to those. It could wait till the end, or if it's something that I'm specifically talking about, then, I'll try to answer them as I go along. Hopefully, Tom, you can kind of help keep track of those for me. I appreciate it.
Sure. Did you want to share your screen yet?
Yeah, I'm going to share my screen. I don't see the share screen thing. That's what I was just getting ready to look for.
It should be there.
Let's see. View participant. I do not see a share screen option.
Do you see in the WebEx Event Center the Quick Start? There should be a share screen button.
Okay, that's why. Yep, I wasn't in the Quick Start. Okay, there we go. Share my desktop. All right.
There we go.
There we go. So that helps. Okay, so basically, Tom has already gone through this disclaimer. This is obviously for educational purposes only. I'm not a broker, dealer, licensed financial advisor, registered financial advisor. So, and I'm not going to bore you with all the details. It's basically the same thing, and you can read this disclaimer, but it's the same as what Tom mentioned, except for I'm added on it as well. So, so let me get started here. As I mentioned, I have been doing the Weirdor alert service for about almost a year and a half now, and the nested and Condor service for about 4 months now. So I just wanted to kind of, first off, he wanted me to go through and just kind of show you how it's going. And then I'm going to talk about each of the trades and the similarities and the differences and so forth. So, and what's been going on in the market and how they are holding up in the, especially the current market conditions, but in general in different types of market conditions. So With that, I'm just going to go real quick over to the internet and just kind of give you guys an overview of how the trade, how the performance has been going. This is a list of the track record in a Reg T account for the Weirdor strategy. And as you can see, it goes back to November 2013, which is basically when I really started trading that strategy the way I trade it now. And as you can see, it's pretty consistent. Of course, there's going to be a few losers in there, but I try to keep those as small as possible. And over that, in this case, 32-month period, basically the account or the percentage of profits was 94.97, averaging about almost 3% a month, which is pretty typical. I try to get like 3 to 4% a month. This is a monthly trade that I do every single expiration month, as you can see here. And as you can see, if I go to the Capital Discussions members website and look at the history since I started this service, so that was when I actually started trading the trade. This is when I started the service back in February, beginning of February. So I've gone through about 16 monthly cycles, and as you can see, again, pretty consistently profitable, a couple of losses there. But as you can see so far, I still have the July trade is still open. At this point, I expect a small loss. I'm trying to make a smaller loss out of what's been a pretty difficult month, but still, possibility to make profit in it still, but I just don't think I'm going to stay in it and keep the risk on, but certainly we'll keep the losses down to a pretty minimal area, hopefully, and take it off either by the end of this week or after the 3-day holiday, depending on how much data comes out over the weekend. So it should be a pretty minimal loss on that one. But as you can see here, this is a nice little equity chart that gets graphed since the start of the service, as starting off with $20,000, and it's grown quite a bit. So over those 16 trades, there's been 14 winners and only 2 losers, and about 42.19% of net profit on the account. So the account's grown by about 42%, so $8,400 in this case on that $20,000 account. So it's pretty robust trade. And as you guys know, we've gone through some interesting cycles through that time. There's been obviously some low volatility, and then some spikes in volatility and some choppiness, and then back to lower volatility. But there's certainly been some challenging months during those times. So it's pretty resilient. And then real quick, I just want to go through the results for the nested iron Condor. So this is my performance on that trade, which I began trading that in 2011. The first cycle was the January expiration cycle in 2011. And as you can see here, it does pretty well, very consistent, usually some pretty high returns, a little higher than the Weirdor. And in this case, over this period of time from 2011, all of 2012, all of 2013, had an average of about 5.84%. There's a few, as you'll notice here, I didn't trade 2014 and 2015. Actually, I traded a few months, but not really much, and I'm going to explain a little bit why I didn't. That's when I started switching over into the Weirdor at that point. But now that volatility's kind of picked back up again, I started the service and started trading the nested iron Condor, and it's again doing well. Not that it wouldn't have done well in 2014 and 2015, just that I wanted to utilize my margin towards a little bit better at that particular point in time, because this trade does better in higher volatility markets than lower volatility markets. Even though it'll make money, it might not make as much as another trade. So obviously I want to utilize my margin as best as possible. As you can see here, starting this service on the 3rd of March, so I've been in the trade 3 closed cycles, and I'm currently have one open. The August trade is still open, which is looking really good. So far so good. Like I said, pretty nice profits. Started off with a $50,000 account, up about 6.71% on the account. On margin, obviously it's a little bit higher. And it looks like the August trade is going to do very well. So far so good. It's profitable, and I expect it to close out as a profitable trade. like the others. So we'll see. Of course, you never know what the market's going to bring, but it's looking good so far. So I just wanted to go over that for people to get an idea of how the services are going as far as results are concerned. And now I want to start my presentation to kind of compare the two and what's going on and what these trades are all about. So basically, as a comparison, both of these trades are obviously they're theta trades, positive theta trades, traded on generally every monthly cycle, and they're high probability, and they're meant to make income on a monthly cycle, basically, and that's kind of what I like to do. They're both high probabilities. There's some similarities about them. They're both high probability trades, generally an 80% or above win rate. They can be traded on indexes like the Russell, the RUT, the SPX, the NDX, or ETFs or stocks, although I find that the indexes are best because you don't have to deal with American-style expiration in case anything is in the money, although in the nested and Condor that would not be the case. You don't have to deal with earnings as you do with stocks, and because the indexes are a higher dollar amount, you can collect more premium, and so the percentage of commissions is very, very low. They both follow a basic set of rules, but there are a few trader's choice interpretations. The Weirdor will have a few more of those trader's choice interpretations than the nested and Condor, which follows the rules a little more rigidly, but there are choices to be made that are pretty simple, though. Both have fairly easy adjustments. Both are, mostly with spreads, either rolling spreads or putting spreads on or taking spreads off. The nested iron Condor tends to have a much simpler adjustment style. I like to adjust early, and there's usually very few adjustments per cycle, maybe 1.5, 2 adjustments on average. And the Weirdor, because that's traded a little bit differently, there tends to be a few, you have to watch it a little bit more. It tends to be a few more adjustments. It's managed a little bit differently. And occasionally, if the market is really moving in a downward trajectory, then there may be times where I actually have to reposition the whole trade. And in that case, obviously, it becomes a little more complicated. Still, dealing with spreads, so they're not difficult, but there's more pieces to work with on that trade. So I would say that there's, more work with the Weirdor than there is with the nested iron Condor. A few other things. The days to expiration entry. So the entry date on these is a bit different. For the nested iron Condor, I like to enter these trades somewhere between 70 and 80 days to expiration. It could be a little bit less, but that's usually where it falls. I find that I get a nice premium and a good distance away from the market on that trade, whereas with the Weirdor, I like to get in somewhere between 40 and 50 days, so a lot less. As far as staying in the trade, how many days am I in the trade? The Weirdor, I'm usually out within 30 days, and that's typical. I like to be out with 14 days to expiration, so that's usually going to be about 30 days in the trade, sometimes less. Sometimes a couple days more, but that's the usual. And then with the nested iron Condor, even though I put it on earlier, a lot of times I'm able to get out within 30 days as well. I'm usually out with, no more than 2 weeks or no less than 2 weeks to go to expiration. The average is usually around 2.5, 3 weeks to expiration is when I'm out. But a lot of times, especially if there's a lot of reversion, a lot of choppiness, I'm able to get out of that trade pretty early. So sometimes within 30 days. And what that enables me to do for the Weirdor is I'm usually in one cycle at a time. So I'm usually only have one trade at a time, so I can utilize whatever margin I want to use for that trade just for one trade. Whereas with the nested iron Condor, there's a possibility of overlap because I might stay in a trade for a little bit longer and then have to get into the next trade. So I might be in 2 trades at a time, so I obviously have to set aside margin for that trade, for the additional trade that I might have. Another difference is the margin usage. So when I put the Weirdor on, I know exactly what my margin's going to be. With all of the pieces that I put on in the Weirdor, there's 4 pieces. There's a credit spread. There's 2 credit spreads, one on the calls and one on the puts. There's a debit spread on the puts, and there's usually a far out of the money put additional just for some hedge. And once I put all of those pieces on, I know what my margin's going to be, and it's going to change slightly based on, I'll leave a little bit of extra to, purchase some additional protection, an additional put debit spread. But I pretty much know what my margin's going to be from the beginning, with a little bit of change up or down, very slight. So I have an idea from the get-go what my margin's going to be, and I know I'm only going to be in it once per one trade per cycle, per month. So I can really have a good idea of how I'm going to utilize my margin. Whereas with the nested iron condor, I tend to be, I start off really, really small, because it's managed completely differently, which I'm going to go over in the next slide. It's because it's managed differently. It's managed more on a high probability basis, and keeping myself, far out in the wings. I may have to increase my contract size when I do adjustments on that trade. So if I'm going to possibly, and I never know if I'm going to or not, but if I'm going to possibly have to increase my contract size if I have adjustments, I want to make sure that I set aside margin for that. So I always start off really small so that I can grow it to the maximum amount of adjustments that I'm going to allow for that particular trade. And I also want to put a little bit aside for if I'm going to have 2 on overlapping for a short period of time as well. So it doesn't utilize, it utilizes a very, very small portion of margin to begin with, but I have to put a lot of margin aside. Usually what I do is I triple it just to be safe, even though most of the time I never use all of that. Most of the time maybe I'll use half. But I'll start off with like a third, and if I have some adjustments, it might reach to use a little bit more. But because of that, I'm not necessarily utilizing my margin as well as I would with the Weirdor. So it's got, some pluses and some minuses there. So let's go to, and I'm going to talk about, that a little bit further as well. So this is just kind of an overview. Some other comparisons that I wanted to talk about are trading by the Greeks or probabilities. So the Weirdor trade is a trade that's traded more by the Greeks, flatter T+0 line, and I want to keep my, deltas in line. I don't want to get things too out of control where it could be, falling off a cliff in either direction. So I'm trading more by the Greeks in that particular trade. And because of that, my adjustment style obviously is going to be a bit different. And whereas with and also I'm going to try to keep, as the trade progresses, any drawdowns should be, kept relatively small. I mean, there are going to be certain cases like, a huge volatility pop like what we had recently, which just drops the whole T+0 line down, where it makes it kind of exasperates a drawdown, even though it might be in a good position on the graph. But in most cases, the drawdowns are kept pretty small on that trade. Whereas in the nested iron condor, I'm trading it more on probabilities. I don't really care so much about the Greeks or the deltas or trying to keep them flat, because as you know, with an iron condor, it starts off, as more of a frown. You're kind of up on top of a hill, and it could, fall to either direction until more and more days to expiration go by, more and more days in the trade go by. That'll flatten out a little bit, give you a little bit more wiggle room, but pretty much it's kind of hard to, keep that flat and still have enough premium to bring into the trade. So it's traded more on probabilities. I stay way outside of the wings. I give it much more room on the downside than the upside. And I use a rolling strategy with a limit. I do not continue to roll forever, and I do not roll out to future months and you know, roll losses forward or anything like that. I do have a max loss on this trade, and I will roll, you know, up to 3 times, and I will possibly go, I'm willing to go as much as 2.5 to 3 times the amount of contracts I started with, which is kind of goes back to that whole thing I talked about with margin. I want to have a very small margin to start off with because I might grow it to the maximum size that I want that particular trade to be. So, so it's just traded a lot differently. So it can look like it has some drawdowns that become a little bit larger, but I do have a max loss. And generally, my trading style with this, with very early adjustments, rolls that can, you know, are push things out pretty far. It doesn't take much of a reversion or a just kind of a range, the market to stay in a certain range to really start to see profits build in the trade once theta decay starts to take over. So that kind of goes into you know, the adjustment style. The Weirdor tends, because it's managed more by the Greeks, it tends to have more adjustments, and you got to keep on top of it a little bit more. Doesn't mean that you have to be sitting in front of your computer all the time. You know, there's certainly, I do have certain alert points where I know I'm going to have to do something, and I can always put in a contingent order to take care of that for me. Usually it's just adding a put debit spread on the downside or possibly removing some of the calls on the upside. Whereas the adjustment, and I'll, you know, continue to do that, and usually that's all that's needed. On occasion, and especially when volatility starts to really kick in and things start to get really choppy, it becomes a little bit more difficult to manage the trade, but not impossible. And, you know, still, as long as it's managed properly, it could still make a nice profit. But there's just a little bit more work to do compared to the nested iron Condor. So just got to keep on top of it, and usually it works out just fine. As I mentioned before, there are occasions where I may have to reposition the whole trade, but I do it in pieces, which makes things pretty easy. I usually will, you know, put the orders and kind of queue them up in Thinkorswim, which is what I use, which you can do the same thing in many of the other brokerage firm platforms, and just kind of queue up the different pieces and then just kind of get them filled one at a time. And it's usually not that difficult to do that. As far as the nested iron Condor is concerned, it's really easy to adjust. It's a very easy, you know, all I'm dealing with is credit spreads on each side, and all I'm doing is rolling them and deciding, you know, how many contracts I may or may not want to increase that roll to. So a very, very easy adjustment style. Again, I don't really look at the Greeks in that particular type of trade. I'm just working off of probabilities, and I do pay attention to target. Target profit. You know, once one of the credit spreads gets down to like 40 cents, or sometimes even a little bit more or less, I'll just take it off. I'm not going to roll that down. I'm not going to try to get whiplashed. I'm not going to try to make a few extra pennies. It's just gone. So if there is some reversion, I don't have to worry about it anymore. And then as far as the bad side that gets rolled down or up, depending on which way the market's moving, usually that's enough to be able to eventually get enough theta out of that roll and remove that as well, unless it's a continual move in one direction or another. And then that's where the max loss will come into play. I will keep an eye on that. So I'll do, you know, a maximum of, my style is to do a maximum of 3 rolls, which I will increase contract size. Sometimes I don't on the 3rd roll, sometimes I do, and then after that I watch for my max loss, which is generally about 1.5 times the original credit, and take it off. And it just doesn't happen very often because it's just a very high probability trade. We don't end up in markets where very often there are 2 losers in a row. Not that it can't happen, but because I have that max loss in place, and because most of the time there's a pretty decent profit, the end of the year usually gives them pretty consistently nice profits by the end of the year. So, and as well as the Weirdor, they both, as long as I'm consistent with them and making my adjustments accordingly, they tend to be very consistent, as you saw with the results. As far as downside and upside resiliency comparison with the 2 trades, on the downside, The Weirdor tends to have more, well, I shouldn't say that, it doesn't have more resiliency. The T+0 line tends to be more flat, but the nested on Condor, you're way out in the wings. So even though the T+0 line might not be so flat and you might be falling off what looks like you're falling off a cliff, it's not going to be long before I roll those puts, the short puts, out of the way and further down and give myself some more breathing room, which usually helps. So it's got actually some pretty good downside resiliency to have a pretty decent move to the downside. As far as upside resiliency, the Weirdor definitely shines there compared to the nested on Condor. I don't really, I don't have a lot of upside risk on the Weirdor. And I don't really want to, I'll have a few credit spreads on that side, but I'm not trying to defend them too much. So if there is a low volatility, consistently rising market, the Weirdor usually shines in that type of market, which is what I'm going to talk about in a minute, was why I didn't trade the nested on Condor during 2014 and 2015. So that's one of the things I want to talk about now is different environments, high volatility, low volatility, up, down, or choppy markets. They both do really well in pretty much all markets. However, the nested on Condor is going to do much better in a high volatility, choppy market, and still do fine in a low volatility up market, but just not as well. And in a down market, it should also perform unless it's like severe down moves that continue for a long time, which is one of the things we saw in 2008. But that doesn't usually happen. Usually downside moves are pretty quick and violent, and then we get reversals, so they don't last as long as the upside moves. So these continual low volatility markets with continual gradual upside moves that just keep moving up and up and up and up, and volatility keep going down, they tend to make the nested on Condor struggle a bit because you just don't get enough premium when you're rolling your upside calls. The Weirdor tends to do well in most markets. It's going to have more of a challenge in choppy markets. It doesn't really have a lot of upside risk. If there's a low volatility up moving market, it's going to do great because there's just not a lot of risk to the upside, and I usually remove it pretty quickly and take advantage of any kind of upside moves to make a profit. So it does well in those markets. When in a higher volatility market, it does okay once you're in the higher volatility market, but when you're transitioning into a higher volatility market, it can be a bit challenging, as it's been lately. And it can be also a bit challenging in choppy markets because I might be making an adjustment on one side and then have to do another. So that takes money out of the trade, so it can be a bit challenging there as well. But as you saw with the results, over time, both of these trades do very well. So this is just kind of an idea of, I wanted to just show these side by side when I talk about markets and, the Condor not performing as well in a lower volatility, constantly upward market. So as you know, in 2011, we had pretty decent volatility in 2011. And as you can see here, the trade did really well. I averaged about 8.34% gain on max risk, and I traded every cycle except for September. I happened to be on vacation in July, pretty much for the whole month, so I didn't trade the September expiration, which would have been traded in July. 2012, still pretty decent volatility throughout that until towards the end of the year. As you can see, it kind of started dropping down. Still averaged pretty decent, about 5.52%. And then in 2013, as you guys remember, we had this, market where the volatility just kept going down and down and down and down. The market just kept grinding up and up and up and up. And so it was a little more challenging. And so some of these months were lower percentages as far as gain, and I didn't get to keep as much of my original credit. I had to make quite a few adjustments on the upside. It was much more difficult, and as you can see, my average is down. Doesn't mean it's not a valid trade. It just wasn't utilizing margin quite as well, which is why I went to the Weirdor, which the Weirdor tended to utilize margin better during that time and make an average of 3 to 4%, sometimes higher during those months. So if I go back to 20, no, I don't have 2013 here. I didn't start trading until 2014, excuse me. But as you can see here, some pretty decent profits during that time, 2014 and 2013, getting some pretty good yields out of it. So, and it utilized margin a little bit better, which is why I kind of switched. However, I know people that were trading the nested iron condor during 2013, 2014, 2015, and did fairly well. I know Bob is on the call. I'm not sure if he wanted to speak at all, but he, if he wants, he can talk about his results during that time. I know he had mentioned to me that he had traded it consistently since I taught a class in 2013, the nested iron condor, and traded it consistently since then, and had been doing quite well. He did a couple of tweaks for his style of trading, took a little bit less risk, but he said he was profitable most months during that time as well. So still, like I said, a very valid trade. So what I wanted to do as well is go to the Option Explorer and just kind of go through, we've been through, I should have probably popped this up before. Let's see here, just real quick to kind of give some more comparison real quick. When I started this trade, this is the difference between what a nested iron condor would look like compared to a Weirdor starting off the trade. I started these trades for the, in the nested iron condor, it would have been the August expiration cycle. Started that on the 2nd of June, and then on the 3rd of June, I actually started my July cycle for the Weirdor. So they were started one day apart, just different expiration cycles. But as you can see here, this T+0 line, this blue line, I definitely get more room to the downside than the upside on the nested iron condor. But as you can see, you don't have this really super flat T+0 line. It's just not that type of trade. It's much more rounded. But as I'll show you as this trade progressed, it's pretty resilient considering we went from a pretty low volatility market to a pretty high spike in volatility and some decent downside moves. And then let me just go to the next day and go to the Weirdor trade. And as you can see here, let me get rid of these lines. The T+0 line tends to be a little flatter. I'm not sure exactly what time of the day I put that trade on, but a little bit. Well, anyways, it's a little bit flatter. It doesn't have quite that, drop on either side. You get some wiggle room to each side before making adjustments. So it can be, a little more, obviously, like I said, I like to manage this more by the Greeks, keep the deltas pretty small, keep my theta positive and my vega a little less negative than on the nested iron condor. Let's go back to that one real quick. So here you go. Let me go back a day. I started that one. As you can see, I'm not as concerned about what my delta is. I do want positive theta. My vega is going to be a lot more, a lot higher. My negative vega is going to be a lot higher in this trade. But as I'll show you, even with that huge volatility pop, this trade really, was very resilient. So let's see if there's any questions. Tom, I don't know if you've been keeping track of any questions. I didn't see anything pop up.
Yeah, I haven't seen any questions yet.
Okay.
I don't know if Bob's here or not. I unmuted him, but
Yes,
I don't know if he's...
I am, Tom.
Oh, there you are. Hey, Bob.
Hey, Bob.
Hey, Amy, how are you doing?
I'm doing good. How are you?
Good. Doing fine as well, thanks.
Good, good. Yeah, I wanted to just see how things were going. I know I had mentioned earlier that even though I did not trade the nested iron condor during 2014 and 2015 because I was utilizing my margin in the Weirdor trade, you had mentioned that you did, and it was doing, I know you made some tweaks to it, but it had been doing very well even in those lower volatility markets. So I just thought maybe you could talk about that a little bit if you like.
Sure. 2014, I had 8 winning months and 4 losing months, but my losers were about 60% or 65% or so of my winners. So overall, I was up just a hair over 4% a month.
That's very good.
And then last year, I had 9 winners and 3 small losers. So my results were even better.
Fantastic.
And, so they were close to, I think we were like 5.4% per month.
Oh, wow, great.
And this
That's kind of
year's
like
been difficult, and it really kind of started towards the end of last year. My three losers were 3 of the last 4 months of the year.
Okay.
So after having 8 straight winners, I started to run into some issues. And this year it's been difficult. I'm up. I've closed out everything except my August trade, and I've only had 2 winners and 5 losers. But
Now I know
I'm up $500, $520 overall over those 7 months of trades. And
now I know you
part
do.
of it is,
Oh, go ahead.
Amy.
Oh, I was just going to say, I know you do things a little bit differently.
Yeah.
So, because I know that I've had I don't know which months you are referring to, but
Yeah, for this year, I had January was a nice month. I was up 12.2%, and was it then? Let me see, am I getting this right? You know, 11.4%, and then April, I was up 10%. But my February and March, and May, June, July were all small losers.
Interesting.
And I noticed
yeah.
when you made a presentation, like before you started this service, you kind of paper traded a few months. And March was one of those months where you had a profit, where I had a loss. And the difference was I started one day after you did, and it was just a timing issue.
Oh, interesting. I wonder what you think about the May, June, July. Since I started the service in May, June, July, those are real trades.
Yeah. So let's see.
I wonder what the difference is.
Yeah, for May, yeah. The reason that I had a loss is because I stuck to my rules, which were if I have to more than double or slightly more than double my initial margin, I'm going to take the trade off and take a small loss.
I see.
So
okay.
I took a $1,380 loss, which is like about 1.67% of my max margin.
Okay.
I did then play the trade out in option net to see what would have happened had I continued to roll, and I would have been able to ultimately make about a 1.8% profit.
Okay.
So that month, the difference was indeed the fact that I use a little bit different rules than you do.
Okay.
And the same thing with let's see, that was a May trade. Okay.
Right.
And then the June trade was the same story.
Okay.
I took a small loss because I wasn't going to more than double my margin. Had I gone ahead and played it out, I could have made about a 2.5% profit on the margin I would have had to use, which is about 60,000 more than I did use in the trade that I closed.
What about your July trade? Because I didn't even have I don't even think I had an adjustment in July.
Yeah, I put mine on May 6th, took it off on June 6th for a small loss, 2.21%.
Okay.
I did not play that one out yet because I was traveling, so I want to go back and see how that might have played out. It could very well be if I had gone ahead and made another adjustment, I might have been able to come out with a profit there too.
Yeah, I didn't even have, I don't think I had any adjustments. So it's just obviously, we'll have to chat offline at some point. I'd like to see the differences because I didn't have any adjustments on that one. But I did take it off early. Because I didn't want to, keep the risk on. And then I kept just a paper version of it on for my class to see if I would have not taken it off early because I didn't have any adjustments to do. So I I took it off, early, and then since I would have had, a maximum of 3 adjustments had I just kept it on. It would have actually ended up to be even more profitable, but I just felt like, hey, I'm up 8.1%. I don't need to keep it on, just take the margin, use it for something else, go on vacation, that kind of thing. It's just the way I look at it. But it'd be interesting to see the differences. But I didn't find any of them much of a struggle. I think the most I had was in the June trade. I did have a couple of adjustments on that one. And then I think maybe 1 adjustment in May. Yeah, so we'll have to chat offline and compare notes to see what's going on there.
That would be good.
Okay.
I'd like to do that.
Okay. Well, good.
My February and March trades that were losers, I played them out, and they both would have been max losers.
Okay.
So,
Interesting.
in the overall, had I carried all of them out January through June trades, I'd be worse off than I actually am.
Could be the entry too, but we'll have to take a look at that, because I know I did. Like you mentioned, I did paper trade the first 3 months of the year, and they came out fine. Of course, I didn't do them for real, but I have a pretty good idea of what the slippage would be. So it'd be interesting to compare notes on those 3 as well.
Right.
But these are the ones that are actually live. So, as I mentioned, they tend to do well in, once the volatility started picking up a little bit more. I thought, let's take advantage of this. This is a great trade to put on now, especially when you're getting a little bit more premium. Even though it does well in the lower volatility markets, it's a lot easier to deal with and certainly brings in a lot more money when the volatility starts to pop. So, I appreciate you coming on and telling us how your trades are doing. I'm sorry this year isn't as good, but we'll definitely have to go offline and compare notes and see what's going on. Maybe we'll tweak your version a little bit to get you better results.
That'd be great.
Cool. Well, good.
I'll give you a call and see if maybe we could set a time to do that.
That would be great. I'd love to chat.
Okay, thanks.
Cool. Well, thanks. Thanks for coming on. I appreciate it. I think
Amy, we did get a couple of questions.
Sure. Half as many. Does Bob have an equal amount of puts and calls, whereas Amy has half as many calls? I put on the same. I'm not sure what you mean, David. I do put on the same amount when I first start off the trade. I'll put on the same amount of calls as I put on my puts for the nested iron Condor, not for the Weirdor. That's a different trade. But if you're talking about the nested iron Condor, which is what Bob trades, I put the same amount of puts and calls on. Obviously, I split the strikes. But I think our adjustment style is a little bit different as far as like he says, he doesn't want to increase his margin more than double. I just start off with a very small margin. I'm willing to increase it more, so that could be an issue. Also, the entry timing could be as well. So I'm going to have to talk with him and see how that's working out. And the version that I'm doing for the class seems to be doing very well, but it'll be interesting to see the differences. And Peter, you're asking, how do the nested IC and the Weirdor compare calculating the return over the total account normalized to a $30,000 account? Well, let's take a peek. Let's see here. So normalized over a $30,000 account. I would say, so I'm using 20,000 here, 42. You don't happen to have a handy-dandy calculator for that, Tom, do you? I'm just going to
just a regular calculator, yeah.
Okay. I thought you had some special spreadsheet in your toolbox or whatever, but I would say, the pound for pound, like margin to margin, same amount of margin to use for the Weirdor and the nested iron Condor. The Weirdor, if I can pull out a 3 to 4% or a 3% average return, I'm going to get a higher return on the account for the Weirdor than I am for the nested iron Condor, but I'm going to have to work a little bit harder at it, which is why I used the Weirdor, just had a better way of utilizing the margin when the market started getting really low volatility and just started grinding up, because I knew that I wasn't going to get as high of a return on my nested condors at that point because the premium was so small, and I would most likely be rolling my calls, and I might have a few more losses, or just having to not utilize the margin as well. So for like I said, pound for pound, margin for margin, probably going to make, as long as things aren't going to get too choppy, the Weirdor is going to do a little bit better. But as the volatility starts to rise, then the nested iron condor is probably going to do a little bit better than the Weirdor. But they kind of balance each other out nice. That's why it's kind of nice to, they usually don't overlap each other. So it's actually, I usually trade Kevin's asking for both my Weirdor and my nested iron condor. I usually trade the Russell 2000. It's my index of choice, although I will talk about the SPX trades, for I know I have students that trade the SPX for both the Weirdor and the nested iron condor, and they say it does very well, and I've traded it in those indexes as well and done well, but just not on a regular basis. So but it does do well in those. I like the Russell because it has a nice balance between a higher premium but not too high like the NDX, and not too crazy of a move as the NDX, whereas the SPX seems to be a little bit smoother most of the time, but it has a little bit less premium. It can have a little bit less premium. So, but the two are pretty similar. But I'd say, putting both of these trades on is probably, it makes a good balance. Whereas, if the market starts to get a little choppy, I'll probably do really well in my nested iron condor like I'm doing this month, whereas my Weirdor is going to be a small loser. But I'll make up for that more and more, most likely in the nested iron condor. So, it's always good to have a couple things going on if you have a margin for it. They tend to complement each other really well. Let's see here. Avi's asking, your record on return for 2011 was twice that of 2013. Any idea of the differential? Volatility? Absolutely. It was volatility. Just getting a lot more volatility, a lot more premium. I believe in 2011, the average volatility for the Russell Index, which is what I traded, was around 28, 29, something like that. In 2013, it dropped all the way down to 18, 19, maybe 20 at the most. Quite a bit of a change. And it was grinding up, constantly grinding up. That was the difference. So I was constantly having to make call rolls, which are harder to make. You just don't get a lot of premium on those rolls, and I'll have a couple of additional losers where I wouldn't have had it in 2011. So the average would come out smaller. I also wasn't able to keep as much of my original credit that I brought in, and I was using more of my margin. So again, that's one of the reasons why I moved over and started using my margin towards the Weirdor to make up for that. So, and Kevin, I think I already answered your question. I traded the Russell 2000 index for the Weirdor and the nested iron condor class. But we'll talk about the other ones. On occasion, I like to have people come on. I know for the nested iron condor, I've had it's a fairly new service, but I did have I think Rick Van Buren came on and showed his SPX version of it, and was doing real fine, very fine. So I like to have people come on if they can to show that. Peter is asking, you always do the nested IC in a 1-to-1 ratio for the inner versus the outer trade. Does it make sense to trade, for example, 2 contracts on the inner? Yeah, so if I have an odd number of contracts, it's exactly what I'll do. So I will, if I have an even number of contracts, so let's say for the class, I'm trying to keep it down to an account size of 50,000. But if I have an even number, like I'm trading 6 total contracts for the class trade, I'm splitting it up 3 and 3. So I've got 3 credit spreads on the inside, the inner condor, and then 3 contracts on the outer condor. I could split that up with 2 contracts on the inner and 4 contracts on the outer. And usually when I do split it up, it's usually because it's an odd lot. So maybe I'm doing 5, like you have as an example there, or maybe 15. And in that case, I will put I'll put less, of the contracts on the inner trade, the one that's closer to the money. I want to have less risk closer to the money. I'll put more risk further out of the money. So that is exactly what I like to do. And just as an example, since I don't see any more questions right now, I just wanted to go, I know we're running out of time here, but I just want to go real quick, just as an example of the trade, this particular month, August for the August cycle for the Nested Condor and the July cycle for the Weirdor. This is a great example of, we're changing from a low volatility to a higher volatility, big pop, some crazy stuff going on in the market, and how each trade can deal with it. Not that they both can't, but there's more work in one than the other, and obviously it's more of an extreme situation, but you can kind of see what's going on. So I showed you what this trade started off looking like at the beginning. So let's just go to today. So for the Nested Condor, this trade as of today, I have no upside risk because I was able to remove all of my calls for their target profit. And now I'm working on the, getting ready to remove my downside risk and being able to take a full profit. But I still have availability to roll. And as you can see, the market right now is at 1131 for the Russell. My closest short put is at 970. So, quite a bit of room, even if the market decides to go down, I can still roll away and hope, most likely turn out to get a pretty decent sized profit from this trade. Whereas if I go real quick to the Weirdor, I'm just trying to manage it. Very flat T+0 line. I don't really like to look at the expiration other than, kind of keeping the boundary of where we're at. I'd rather look at the projection lines. And, depending on where we land, I'm planning on getting out of this, by Tuesday next week, hopefully to get the loss down to about half, so maybe a 2%. But, with all the stuff that was going on, that's pretty, not a bad result, trying to keep the losses small. So, for most of the time of this trade, there was actually quite a bit of chance of making some profit still. But at this point, I just really want to, limit the risk and take out some of the loss. So, but as you can see, and this one was, a little bit more work. I had more adjustments going on here, whereas the Nested Condor, even with the, when the market was moving down and we had that huge volatility pop, I think we went from like a 18, RVX was at 18, popped all the way up to 25 on the Brexit move. That's a pretty big pop from the, from before the Brexit happened to when it happened. So it still, was pretty resilient to that, even though it has a higher negative vega than the Weirdor. So, so I just wanted to show that. I don't have any other questions. I did want to mention one other thing. Tom put together a little sales page. Let me get here. So for the 4th of July. Happy 4th, everybody. I know hopefully you guys are going to go out and have a great long weekend. This is a mini, let me just copy that in here. Oh, I
just pasted it in the chat.
Do that, great. So basically what this will do is just take you to a little special page with special prices. It's just 10% off for the 4th of July. So if anybody is interested in checking out those services for the Weirdor or the Nested Condor, there's monthly, quarterly, and 6-month subscription services, and there's also a combination. And there's a 10% discount, so you can save some money if anybody's interested. Would love to have you join. And I think that pretty much wraps it up, unless there's some more questions. So
I think that's it for the questions, and we're right about at an hour, so it's a pretty good timing.
Okay, great. Well, I hope everyone enjoyed the presentation, and hope to see some new faces in either the Weirdor or Nested Condor class. And again, if anybody has any questions, feel free, ask Tom, ask me. I'm happy to help. So that's about it. Hope everybody has a wonderful 4th of July weekend, and be safe and have fun with friends and family.
Yeah, thanks very much, Amy, and thanks everyone for staying with us. And don't forget that URL is cdurl.us/4july, and it'll take you right to that page with the special prices. So thanks again, and I'll get this recording posted as soon as we can.
Thanks, Tom.
Thanks, Amy.
And thanks, Bob, for joining, and I'll talk to you soon.
You're welcome, Amy. Thanks, Tom.
All right, bye, everyone.
Bye.